Welcome to Capital Insights. Thanks so much for being with us today. We've talked a lot about the special nature of the financial market and economic cycle that we're in right now over the last few years, and we've done a lot of commentaries, whether writing or on these videos. And we've focused a lot on what the central banks have done, their quantitative easing, their printing of money, their dropping rates into negative territory. We've also talked a lot about macroeconomics, meaning what has happened with not only the U.S. economy, but really the global economy. And we've seen, growth rates in GDP in this cycle that are some of the lowest we've really ever seen. But there's another issue out there that we have not discussed over the last few years that deserves some mention. And that is the role of debt over the last 7 years in really not only the domestic economy, but the global economy itself. If we run the clock back to the first quarter of 2009, the U.S. federal government had about $9 trillion in debt outstanding. And at the moment, we're ready to cross $20 trillion in debt outstanding. We're not alone. We've seen the same things in Europe. We've seen the same things in Japan. We've seen the same things in China. In fact, debt inside the Chinese economy grew $1 trillion in the first quarter of this year. The numbers are very, very big. One of the reasons we wanted to talk about debt was because debt has also, in addition to the QEs and the dropping of rates, etc., a lot of debt taken on by these governments has helped support these economies over the last X years. And we all know that in the United States, we're facing accelerating entitlement issues ahead. Medicare, Social Security, etc. Well, we're seeing exactly the same thing as we look at Europe, as we look at Japan, and even as we look at China, some of these aging societies. And when we really step back, one of the key questions about debt, and I know there's a lot of commentary out there, look at these debt levels and how pessimistic this may be. But debt really comes down to one thing and one thing only, and that is how productive has been the use of debt over time. And what does that really mean? If we think about ourselves, or if we think about individual businesses, debt can be an investor's best friend, but debt can also be an investor or an entrepreneur's worst enemy. If we think about the baby boom generation, look at what debt has done in terms of equity values in real estate over time. And those values have gone up very significantly, but it was leverage, it was debt that allowed us to participate in that. For an entrepreneur, for a business owner, their greatest dream is to be able to build a business and earn a rate of return greater than the rate at which they financed their company or they borrowed money. So debt can be very, very, very productive, but if it's not productive, it can, if you will, be a drag on future growth rates. So what we thought we'd do today very quickly is look at just the United States and look at all the individual important sectors in the United States and what has happened with debt accumulation and what that may mean as we really look over the next X years. Let's start with the federal government, since we used those numbers originally. Again, $9 trillion in debt, maybe 7-8 years ago to close to 20 today. If we look at debt relative to GDP, the United States back in 2009 was about 60% government debt relative to GDP. Today that number is up over 100%. What has all of that increase in debt done? Did we, if you will, improve the infrastructure in the United States, hopefully leading to greater productivity over time? Well, no, we really haven't. How about upgrading the electrical grid? We really didn't do that either. What we have done is we've supported a lot of ongoing government spending. We've supported increases in Social Security and Medicare. We supported extended unemployment benefits. We supported HARP, real estate related benefits. We have supported a triple in Social Security disability over time. We've grown a lot of debt, but that debt hasn't gone to, if you will, productive use, meaning that in the future we would gain something from that. What it's really done is satisfy very short-term needs. How about the U.S. corporate sector? Corporate debt right now is at all-time highs. And that's not something horrible by any means, because interest rates are at all-time lows. But this is just an example. Last year in the United States, corporate debt grew about $800 billion. But increases in inventory, increases in plant and equipment, building new structures, if you will, physical additions to businesses, increased about $100 billion. So what happened between that mismatch? 800 billion in borrowing, but only 100 billion spent on inventory and new plant and equipment, capital goods, etc. Well, $700 billion, that's the difference, was spent on stock buybacks and was spent on dividend increases. So as we think about that also, when a business borrows, and if you will, uses that money to increase plant and equipment, they put up another manufacturing facility, they're going to put up another retail outlet. Well, what that debt does productively is it increases demand for products they need, but it also increases employment opportunities over time. What do stock buybacks do? And what do dividend increases do? Do they increase our productive capacity over time? Do they increase our employment possibilities over time? They do neither. Now again, is this something horrible? No. The corporate world was totally incented, if you will, to borrow, to buy back stock, and to increase their dividends. But again, what that really says is, and this is a reflection too, of why employment has been so tough, if you will, over the last X years and over this cycle in the United States, is that money really wasn't put to productive use. It was put to very short-term use in terms of trying to maximize stock values. Households. Well, you'll be happy to know that on the household front here, debt has actually declined over the last 7 years. Now, remember, part of that, and we don't mean to be pessimistic about this, part of that was outright defaults and largely related to residential real estate. But household debt relative to GDP has actually come down just a little bit over time. Of course, we know that in the prior cycle, households took on a lot of debt in the United States, really related to residential real estate more than not. And we've worked some of that off over time. That's a good thing. But at the same time, in this cycle, and we've talked about this many a time, consumption has been very, very low. We've seen this again and again and again. Wages have been very, very low. Households are still in that period where they're trying to repair their balance sheets more than not. And they haven't been wildly additive to the consumption side of the U.S. economy. Really more fallout from the prior cycle than not. Lastly, state and local governments in the United States. Back in the prior cycle, state and local governments took on a lot of debt. They took on a lot. They really did. And part of it was because in the midst of, if you will, the residential real estate frenzy, well, all of their fees for permits and residential real estate entitlements, etc., were going higher and higher. So they started borrowing against those streams of cash flows, figuring they would just never come to an end. Well, they did come to an end. But state and local governments have been relatively prudent over the last 7 years in terms of additional borrowings. Unfortunately for state and local governments, though, the issue that's looming large, and it's very much looming large for the United States, as well as really the major global economies, are the entitlement issues, are the pension issues. Again, not to sound, melodramatic, but 20 years ago, 10 years ago, 5 years ago, we knew these were going to be issues. The mathematics was clear. There was no two ways about it, but we didn't do a lot about that over that time period. And now, on the front page, is the city of Chicago and the state of Illinois in terms of pension issues. Houston, Connecticut, New Jersey, Philadelphia, they're now showing up on the front page. So for state and local governments, even though they haven't taken on a lot of debt over the recent past, they face very meaningful entitlement / pension / healthcare issues as we move forward. So it's something that's not talked about on Wall Street a lot. Again, we get a lot of focus on the Fed, a lot of focus on money printing, the global central bankers. There's now $10 trillion in government debt globally that's in negative interest rate territory at the current time. Those kind of things catch the headlines. But underneath those headlines is a very meaningful issue for the global economy too, and that has been the increase in leverage, the increase in debt. As we look forward, we know that debt repayments can often be a drag on the real economy itself. And in this very special cycle that we live in, one of the reasons that so much debt has been able to be taken on, if you will, is because interest rates have been set near zero. If we think about the United States, 7 years ago, we could have borrowed money for 1 year. The government could have borrowed money for 1 year at 5%. Today, that number is maybe 0.15%. So to service that debt doesn't cost a lot. But as interest rates change over time, and this is absolutely one of the reasons the Fed is so reluctant to raise rates, is because they know they're raising the cost of capital for the government itself and really for the global governments. Is the world about to come to an end because we have too much debt? Of course not. Has it all been used frivolously and we never should have done this in the first place? That's a very melodramatic comment. But nonetheless, the debt overhang that we have globally is a forward overhang on economic growth as we move forward, because that debt's going to need to be serviced. So if we're expecting any kind of a return here to 3, 4, and 5% GDP growth in the United States, or really that type of GDP globally, we're kidding ourselves, at least for the near term. So again, we just wanted to point out an issue that we believe is important, that we believe will impact future investment decision making and really business decision making. And again, without the melodrama by any means, it's an issue we need to watch as interest rates change over time. The ability to service debt is going to become tougher and tougher. At exactly the same time that entitlements really across planet Earth, this is not just us in the United States, this is really the global economies, face this issue as we move forward. It just tells us that the search for economic growth, if you will, is going to remain relatively tough, regardless of whether we're in expansion, contraction, whatever it may be ahead. We'll be talking more about this, but again, we thought we'd bring this up because it just doesn't get as much attention, if you will, in the mainstream financial press as we believe it deserves. So we very much appreciate your time in being with us today. On behalf of the entire team at Capital Planning Advisors, thank you so much, and we'll see you very soon. I'm Brian Pretti.